Did you know that 45 million Americans are underserved by the banking industry just because of their not so perfect credit score? Well, this is where OPFI comes in. They're an under the radar fintech that's changing the way borrowers get approved for loans. Now, I last spoke with Todd Schwartz, the CEO over at OPFI, almost a year ago when their stock was trading around $2.50. Today, it's $10. So naturally, I wanted to find out what's been happening. And today, Todd's going to fill us in on his company, what they've been doing, and where they're going. But before we begin, I wanted to give a shout out to The Motley Fool for sponsoring this video. The Motley Fool provides investing insight to investors of all types. So I'm thrilled to partner with them to bring you 10 stock picks from their stock advisor. The average stock pick inside Stock Advisor is up 863% versus 173% for the S&P 500. Scan this QR code or check the link in the description to get your top 10 stock picks right now. All right, let's get started. All right, so we're here with Todd Schwartz. He's the CEO of OPFI. They're based in Chicago, and well, thank you so much for joining us today.
Thanks, Rick. It's good to see you, and thanks for having me on today.
You bet. So the purpose of this interview really is to get the word out about OPFI because retail investors, they may not know about the company. So with that, let's say I'm a retail investor. Do you have a 30-second pitch as to why I should buy OPFI stock?
Yeah, so if taking a step back, if you look at the situation of the consumer finance world in the United States, there's about 60 million people that are underbanked or not banked. And we really focus on the 45 million underbanked consumers. And it's all about credit access, like getting unsecured credit access. And so if your FICO score falls below, call it 650 in the United States, it becomes very difficult to access unsecured credit. And the options become more and more dire the lower that number is. So back in 2012, I wanted to address this supply demand imbalance in credit access. And I said, there's got to be a better way. There was, pawn shops, payday loans were very prevalent at the time, very high interest, non-amortizing, pre-computed interest products that were kind of not allowing people to get ahead or really solving any of their problems. And I said, there's got to be a better product for customers that's customer friendly, better service, transparency, credit education had to be integral to it to allow people to try to improve their financial health. And so we launched OPFI, Op Loans is the consumer product. And we've been doing it ever since. We're the largest, probably pure play consumer lender in the space. We're public now, on the NYSE, OPFI. And we're true to our values and true to our principles, which is we're going to do anything and everything for our customers to provide credit access, the best available credit access for those customers. So little things about our product that are unique, no prepayment penalty, no origination fee, no late fee, full amortization. We even have a return policy for customers that take out the product and say, you know what, I have buyer's remorse here. I'm going to return it with no interest. So just return the principal and we're good. But we wanted a product that was easy to use, easy to understand. We report to all three credit bureaus to allow for people to rebuild, like I have a positive trade line with the bureaus. And, very customer friendly. And so, we're continuing to deliver on that. We're in 40 states. We currently work with bank partners. So we've aligned with a set of banks that also have desire to expand credit access for this population and provide, safe, more affordable and transparent products in this space. And so the banks are actually the originator of the product, and we're the vertically integrated servicer behind it, and all the technology that allows for this to be done digitally in seconds. And so I was really proud to report on our Q4 earnings call that we just recently had. We had 81% auto approval So not only is OPPFI serving a great supply demand and balanced credit access, issue that we have in the United States, we have developed probably some of the best technology, whether it's underwriting, servicing, and we're really starting to deploy a lot of AI tools. So we have best in class technology and the product teams that are constantly refining how we service our customers to get more efficient, but also just a better customer experience.
Interesting. So you mentioned there are 45 million underserved Americans or underbanked Americans today. What percentage of that are you attracting today?
Yeah, I mean, it's still, still fragmented, and obviously we have to operate within the confines of our business. We're a for-profit business, so we can't help everybody. We would love to, but we think that when the product, obviously there's multiple variables in a product, APR, size of loan, ability to repay. So we have to underwrite people because our goal is to have people pay back responsibly and be successful. Like, we don't want people defaulting. So, we have to, we do the best we can to service as many of those customers. I think we've served 3 to 4 million unique customers at this point. Wish it was more, but we also have to work, within the confines of a for-profit business, make sure that people are paying us back and that we're providing good service levels to our customers.
Well, I mean, that sounds like about a 10% market penetration. It sounds like you have some ways to go as well.
There's definitely a lot of room for growth and a lot more. Like I said, we're only in 40 states, so we have to abide by federal and state laws, and so that is some of the our ability to service some of big geographies like New York and other things is not there today. It doesn't mean that we won't have a product for those geographies in the future. But right now, yeah, we're in 40 state, which is a good size footprint. But would love to be in all 50 at some point in the near future.
I can see why. Now, earlier you mentioned that your loans were originated by banks. Are they entirely originated by banks?
Yes.
Or so you don't lend out any of your own money?
So the way it works is, we have various structures with bank partners depending on federal and state legislation. We abide by, all from a regulatory standpoint. The bank makes the origination, and then after the bank makes the origination, they retain equity in the product. But then we have the ability to also participate in some of the paper as well, after they originate, and we're also servicing it. We know the paper really well, so we obviously know the credit, and we have a lot of experience working with our customers, and it's our brand, and so we feel really our confidence level of our customers' repayment rates and our servicing levels for our customers allow us to give us confidence to balance sheet some of the economic interest of those originations.
So what would be some key metrics or milestones, a retail investor like myself ought to be looking at in your financials? Because it can be a little bit cumbersome, especially when comparing.
Yeah, I mean, it's all the we're really focused on net income. Obviously, like EBITDA, you hear a lot, but we have interest costs, right? So we really do look at that, and we think that you look at our, we're growing at a nice clip. We have a really nice growth, but we've also focused on expanding our margins, and that's by just operating more efficiently and really focusing. We just launched Model 6 credit model, which is our most predictive model yet. It actually, so with the bad comes some good. In 22, we had high inflation and we had more losses than we probably wanted, but we came back incredibly strong by using that data to rebuild our underwriting model that really focuses not only on targeting customers better on the front end, but also it really focuses on long-term delinquency and repayments versus more short duration repayment rates. And so it's our most powerful model ever. It's had great success. And a lot of that combined with operational efficiencies we found over the last 2 to 3 years have really propelled not only our growth, but also our profit and our profit margin, right? So we had a really unique. We not only did we double, basically virtually double net income from 23 to 24, we also expanded our net income margin by about 50%, which was something that I told everyone we were going to do back in 22. Not a lot of people, I think, believed it at the time. But we've had a really nice string of earnings now where we've beat and raised ever since the second or third quarter of 22. So we continue to think that the business has a lot of growth, and we think that margins are, we continue to have high ROI investment opportunities for growth, but also operational efficiencies. And, we're really starting to deploy our AI tools in our servicing and our originations. And we think that there's, continued growth there as well.
And you can see the results just in your stock price. I mean, it may seem like an eternity ago, but you and I spoke 11 months ago. At the time, your stock was trading under $3, and today it's it's about 10. It's incredibly impressive. Do you think the stock OPPFI stock is still undervalued?
I think it's incredibly undervalued. If you look at our operating metrics, um, to my knowledge, there is not one company in a peer group where they haven't expanded net income margin 50% in a year and doubled net income. Like, it just doesn't happen. We did a special dividend last year. We invested in a small business originator. We just announced a special dividend yesterday that was double. Um, we're not, we're closely held business, and by me and my family, and like we're highly aligned with shareholders to do the right thing, and we're going to do the right thing and reward shareholders. I think that's a unique, right? We're in a unique position there. But if you just look at our cash position, we don't give value. Like, no one values our cash at all. I noticed. Also, we see businesses that don't have that backdrop of, no, we have no corporate debt, but we have operating leverage, which we use for receivables, but no debt at the corporate level anymore. So we have a really clean balance sheet. We have, a really strong cash position. So we have the ability not only to grow and invest, but we also have the ability to do inorganic opportunities, right? So that's something that we did last year was an investment in Video Advance, and this year we're looking at stuff as well. So we kind of we have a lot of optionality, and I think that optionality is not being properly valued. We also have a lot of growth, and so we want to get, our peer group, when we were in 22, 23, it was fine because we were trading at a really low month. But I think now, with all the improvements to the business and all the optionality and all the growth that we have ahead of us, I think we're seeing a disconnect between sell side institutional and retail. Retail loves us. Retail thinks we should be valued at $20, $25 a share, and sell sides more conservative because they're comparing us to a peer group. But if you look at apples to apples, us versus a peer group, I don't feel that we're being properly valued. I'm sure every CEO says that, but I actually have, empirical data to show that, like, we're doing things that no other company in our space is doing.
So you mentioned shareholder value and the importance of that. I write a lot and talk a lot about income investing. The if you Google my name, you'll see hundreds of pieces about dividend aristocrats and kings and such. And these are companies that typically pay increasing well that pay increasing dividends over a long period of time. Is that something that is on your radar? Is that something that OPPFI is looking to do, to increase dividends for the future?
Yeah, so we it's kind of a menu options of things you can do with your cash, right? And paying down the corporate debt that was more of a term piece that wasn't really usable. The interest rate was high. I felt like, why have this? Let's free up our balance sheet. So I'm kind of always looking at that menu option of like what to do. I think the reason we do a special versus recurring is, like, we got a really high ROI and really interesting things we're looking at that I don't want to commit to future dividends when it may not be best for long-term value creation for the company, right? And so that's why we use the special. We, the one we did yesterday, we announced yesterday, or are going to do in the future here in April. We had an incredible run there in 24, and then obviously our payment season kind of started, and it's been we're coming into that. And so we said, hey, like, we have a little excess cash. We're going to reward shareholders that have really been with us on that ride from $3 to $10. Reward the shareholders for that, and management. Right. And so, but we also have ample amount of cash for investing and ample amount of cash for these inorganic opportunities still. So, that's where we're at today. So, but yeah, I'm always looking at highest and best use of cash, right?
Yeah.
Like where we think, will create the most value, and also reward shareholders.
Reminds me of the Berkshire method.
Yeah.
Never paid a dividend, but happy to collect them.
Right, right, right. I like that. Yeah.
Uh, Todd, is there anything else that you can tell me that I haven't covered today about OPPFI? Because it sounds like you've got a very innovative product, you've got a growing market, the stock price is most likely undervalued. What have I missed? What have I forgotten to ask?
Yeah, I think we came to the market in 21. We were really more of a consumer lender trying to solve the credit access issue and unsecured credit, for the underbanked, right? The 45 million. We're still doing that today, but what's changed now is we have really built out robust underwriting, servicing, technology to allow us to expand and become a platform business for the digital alternative financial space, which includes SMB, Main Street America. There's huge supply demand imbalance in working capital for small businesses. And after the shakeout of COVID, you've had a record number of new businesses founding, and they're going to need capital, right? Working capital. One of the biggest reasons businesses fail today is, lack of working capital. And so we think that when it's the same thing in consumer, when your FICO is not above 700, the options become less prevalent and inferior. And so it is their ability to come in, and if you look at, SMB space, there's, increasingly going online and becoming more and more digital and more standardized, which was one of the problems in the past. It was hard to standardize a lot of the information. That's getting better and better. And so we see there's a huge tailwind there. We're also looking at the consumer POS space. We think that being embedded with merchants for everyday expenses in medical, auto repair, house, like, things that people need, like beds, sofas, there's definitely a value there. And it's very, very complementary to our core business, where we can offer a best-in-class product with best-in-class servicing and product features. The OPFI is really going through a metamorphosis of kind of this consumer, operator, servicer with bank partners, to really more of a platform business where we're going to have a suite of digital alternative financial service products. And it's going to be an exciting journey here for the next 3-4 years. We're well in the throes of it with the announcement of the Biddy investment last year. And we're also looking at some really interesting things right now.
Well, it definitely sounds exciting because I've been at the retail bank, and it can be a challenge if you don't have if you don't tick all of the boxes, right? And it sounds like you've got a product that answers the needs of those borrowers who actually can and want to repay, but maybe just can't convince their bank to be able to give them their loan.
That's right. Yeah, absolutely. Banks can give you money. It's probably less. It might be a little bit less expensive, but you're going to wait, and you're going to have to go through a long process, right? And so that's where the opportunity is, and really banks. We've aligned with bank partners that have that, but I would say the large banks, the really big ones, really have. There hasn't been a lot of interest, for them to service this space. And so we're, that's our job, right? To fill in the blank, and be there for our customers in time of need.
Todd, this has been great. Thank you so much for joining me today. It's always fun to chat and hear about your growth, and I look forward to chatting with you next time and seeing that progression.
Great. Well, thanks for having me on, Rick. I enjoyed the time and look forward to discussing this with you again in the near future.
You bet. Take care.
All right. Bye.